This is BBIU, Biopharma Business Intelligence Unit. We provide structured insight and strategic analysis. In a world saturated with noise, surface narratives, and politically shaped data, BBIU operates at a different level of resolution. We focus on the forces beneath events: geopolitical and geoeconomic realignment, biopharma structural dynamics, liquidity stress and financial fragility, institutional drift and epistemic erosion, the architecture of power in global systems. Our work is guided by three principles: truth, structural coherence, and verifiable inference. Every model, every report, every forecast you see here is part of the analytical framework we use to brief decision makers worldwide. If you're looking for information, there are many places to go. If you're looking for structure, welcome. An unusual weekend signal: why Korea's emergency FX meeting marks a structural threshold. Deccan 19th. When currency stress forces welfare and industry into an FX room, the problem is no longer exchange rate volatility. Executive summary. On December 14th, South Korean authorities convened an emergency weekend foreign exchange meeting following a rapid depreciation of the won beyond the 1,470 to 1,480 per dollar range. What makes this event structurally significant is not the level of the exchange rate itself, but the composition of participants. Alongside the Ministry of Economy and Finance, the Bank of Korea, the Financial Services Commission, and the Financial Supervisory Service, the meeting unusually included the Ministry of Health and Welfare and the Ministry of Trade, Industry, and Energy. This was not a routine FX stabilization discussion. From a BBIU perspective, the meeting represents a regime shift signal. Currency volatility has crossed from a financial market issue into a macro structural stress vector, threatening employment, industrial liquidity, welfare stability, and fiscal transmission. The Korean won is no longer reacting passively to global dollar strength. It is beginning to price domestic structural strain. Lie, truth. The FX move is not the cause. It is the surface expression of accumulated internal stress. Weekend FX meetings are rare. Weekend FX meetings with welfare and industry ministries present are rarer still. Authorities do not mobilize social policy and industrial portfolios to discuss speculative currency swings. They do so when currency pressure threatens employment continuity, industrial financing chains, pension and welfare disbursements, and systemic confidence in domestic balance sheets. The won's recent depreciation is not a discrete shock. It is the externalization of stresses already active inside the Korean economy, including a deteriorating construction and project finance pipeline, SME liquidity failures cascading through subcontracting chains, rollover stress in short-term credit structures, and rising foreign currency demand from institutional investors. The FX market is reacting after these mechanisms are already in motion. Law 2. Reference. This pattern has historical precedent, but the institutional response reveals the phase. In prior episodes of FX stress, Korea's response followed a clear hierarchy: market monitoring, verbal guidance, volatility language, financial coordination, MOEF, BOK, FSC, industrial or social mobilization only when spillovers were imminent. The inclusion of welfare and industry ministries places the current episode beyond Phase 2. This mirrors late-stage patterns observed in other credit-driven economies where asset prices remain defended, but currency markets begin to price the cost of defending them, forcing governments to confront distributional and employment consequences. The signal is not crisis, it is loss of insulation. Authorities do not mobilize social policy and industrial portfolios to discuss speculative currency swings. They do so when currency pressure threatens employment continuity, industrial financing chains, pension and welfare disbursements, and systemic confidence in domestic balance sheets. The won's recent depreciation is not a discrete shock. It is the externalization of stresses already active inside the Korean economy, including a deteriorating construction and project finance pipeline, SME liquidity failures cascading through subcontracting chains, rollover stress in short-term credit structures, and rising foreign currency demand from institutional investors. The FX market is reacting after these mechanisms are already in motion. Law 2. Reference. This pattern has historical precedent, but the institutional response reveals the phase. In prior episodes of FX stress, Korea's response followed a clear hierarchy: market monitoring, verbal guidance, volatility language, financial coordination, MOEF, BOK, FSC, industrial or social mobilization only when spillovers were imminent. The inclusion of welfare and industry ministries places the current episode beyond Phase 2. This mirrors late-stage patterns observed in other credit-driven economies where asset prices remain defended, but currency markets begin to price the cost of defending them, forcing governments to confront distributional and employment consequences. The signal is not crisis, it is loss of insulation. The presence of welfare officials implies concern over employment spillovers, household income vulnerability, and downstream fiscal exposure if construction and industrial credit tighten further. The presence of industry officials implies awareness that FX volatility can accelerate import cost pass-through, disrupt export-linked financing, and destabilize energy and materials procurement. This is cross-sector risk mapping, not market signaling. Law v. Inference. What this meeting tells us about the road ahead. 3 inferences follow logically. FX volatility will be tolerated only within narrowing bounds. Verbal intervention alone is unlikely to suffice if underlying dollar demand persists. Credit containment will remain asymmetric. SMEs and PF-linked entities will continue to absorb adjustment before households or flagship asset prices are allowed to move. Narrative support for real estate will intensify even as FX weakens. This divergence, strong property rhetoric alongside currency stress, is a classic late-cycle configuration. The key risk is not abrupt collapse, it is policy exhaustion, the gradual erosion of tools that allow stress to be redirected without visible repricing. ODP-DFP Structural Layer Orthogonal Differentiation Protocol. ODP claim. The FX event is not an isolated volatility episode. It is a visible breach of the system's compartmentalization architecture. South Korea's macro system has historically relied on compartmentalization. Stress is absorbed inside specific silos: construction SMEs, PF vehicles, non-bank lenders, local subcontracting chains, while flagship prices and headline stability optics are defended. The December 14th weekend emergency meeting, especially with participation beyond the standard FX financial perimeter, signals that this compartmentalization is failing. The state did not convene welfare and industry to calm a chart. It convened them because FX stress is now threatening cross-domain execution yield. In ODP terms, the shock is orthogonal because it traverses domains that are normally managed independently: FX and capital flows, MOEF, BOC, FSC core, welfare and household stability, health, welfare administration, industrial procurement and production continuity, industry energy policy. When these 3 enter the same room under an FX trigger, the system is acknowledging a shift from financial market management to national production and social stability management. ODP dilemma. Korea is attempting to preserve domestic asset price optics while the external price, KRW, begins to clear the hidden internal deficit. That is not a narrative conflict, it is a balance sheet constraint. Dynamic failure pathway. DFP claim. The system is executing a staged stress transfer sequence. PF SMEs, non-bank credit, FX, household burden, policy exhaustion. This pathway explains why property narratives can remain bullish while FX deteriorates. DFP Step 1. Internal absorption via the weakest nodes. The first casualties are not prime apartments. They are the least visible liquidity nodes: construction SMEs, subcontractors, PF bridge structures, and regional projects. This is where payment chains break first, because these nodes lack refinancing power and political visibility. DFP Step 2. Containment through rollover selectivity rather than visible default. Instead of mass foreclosures, the system tightens through non-renewal, covenant tightening, and silent reclassification. This keeps headline prices stable while shrinking the credit oxygen available to the production layer. DFP Step 3. Externalization into FX. As domestic stress is prevented from expressing as price discovery in real assets, it migrates into the currency. FX is the market where the state has the least ability to delay clearing without paying costs elsewhere. This is the core structural mechanism. The system is defending internal asset optics by allowing external repricing through KRW. DFP Step 4. Inflation and household conversion pressure. Once FX rises enough, import cost pass-through and household budget stress intensify. Housing may still hold, but affordability and monthly burdens worsen through indirect channels. Rent structure shifts, refinancing terms harden, and disposable income compresses. DFP Step 5. Policy exhaustion and forced repricing. When FX and funding costs become politically and operationally binding, the system loses the ability to keep stress localized. At that point, repricing migrates back into domestic assets and employment, not because the narrative changed, but because the containment pipeline ran out of capacity. ODP DFP verdict. This weekend meeting is a structural threshold because it indicates Korea is crossing from DFP Step 2 to Step 3, from hidden internal absorption to externalized clearing. The unusual ministerial participation implies officials are no longer asking, can we stabilize FX? They are asking, what sectors fail if we do not, and what do we break if we try? That is not a market question. It is a state capacity question. BBIU structural conclusion. The December 14 emergency meeting is not important because of the exchange rate print. It is important because it reveals that Korea's compartmentalization regime is weakening. ODP identifies the event as a cross-domain breach. Welfare and industry entered an FX room because FX stress is now threatening national execution yield. DFP maps the sequence already in motion. Stress has been absorbed in SMEs and PF structures, contained via rollover selectivity, and is now beginning to clear through KRW, pushing the burden toward households and eventually forcing policy exhaustion. The critical question is not whether property narratives remain bullish. They will. The question is whether the state can continue delaying domestic price discovery without allowing FX to become the clearing mechanism for every hidden imbalance. Annex, submerged structural charges. What the FX narrative does not say, but the system already knows. Annex 1, construction activity, the silent collapse behind supply shortage. The dominant media framing describes Korea's housing market through a single axis, price resilience under supply constraints. What is systematically excluded is the collapse of construction activity as a production system. This is not a cyclical slowdown, it is a pipeline fracture. Observed realities. New project starts have collapsed outside a narrow set of legacy or exceptional developments. Construction SMEs are exiting not because of demand collapse, but because credit rollover has failed. Payment chains are breaking at the subcontractor level, long before price indices react. Workforce contraction in construction is persistent, not seasonal. The critical distinction omitted by media narratives is this: a market with temporarily low supply behaves very differently from a market with a destroyed supply pipeline. Korea is now closer to the latter. This matters because once the pipeline is broken, future price behavior becomes disconnected from current price narratives. Scarcity does not imply strength if the production system that replenishes stock is no longer financially viable. Annex 2, media narratives, why prices are discussed, while production is not. Korean real estate coverage has converged on a narrow informational band. Transaction prices, regional winners, Seoul, select Gyeonggi nodes, expert commentary anchored in past cycles, regulatory expectations. Absent almost entirely, SME insolvency statistics. PF rollover failures, construction employment loss, payment arrears, forced sale dynamics, credit reclassification behavior inside banks. This is not accidental. From an ODP perspective, the media is acting as a price stabilization interface, not an information discovery mechanism. Prices are discussed because they are slow-moving, politically sensitive, and socially anchoring. Production and credit mechanics are avoided because they signal irreversible damage, precede price discovery, and undermine confidence before policy tools are exhausted. The result is a narrative inversion. The public is told that prices explain system health, while in reality, system health is already deteriorating in layers that prices have not yet been forced to reflect. Annex 3, the SME sacrifice layer. One of the least discussed structural decisions is where the system allows failure. Korea's current configuration is implicitly choosing to protect flagship asset prices, to preserve household confidence, and to delay visible repricing by allowing construction SMEs and subcontractors to absorb the adjustment. This layer is structurally convenient because SMEs lack political voice, failures are dispersed and non-synchronous, and their collapse does not immediately move price indices. However, this is not costless. Every SME failure permanently reduces future construction capacity, skilled labor retention, regional economic resilience, and execution speed for any later recovery attempt. This is not cyclical cleansing, it is capacity destruction. Annex 4, the Jeonsa blind spot. Jiangxi continues to be discussed primarily as a price or affordability issue. What is underreported is its role as a latent leverage transmission mechanism. Key realities. Jiangxi deposits function as quasi-balance sheet leverage for owners. Rising FX and funding stress increase the cost of refinancing Jiangxi refunds. Conversion from Jiangxi to WOLS is not neutral. It shifts stress from asset price to household cash flow. As long as Jiangxi stress is absorbed via loans, extensions, or owner liquidity buffers, prices appear stable. But once refund stress becomes binding, forced asset sales emerge without prior price signaling. This is one of the most dangerous hidden triggers because it bypasses sentiment entirely. Annex FOF Project Finance. The managed silence PF stress is often acknowledged in abstract terms, but its execution mechanics remain opaque by design. What is happening now? PF exposure is being reduced through non-renewal, not default. Losses are being socialized temporally through restructuring, not crystallized. Banks are preserving headline ratios while shrinking effective risk tolerance. This creates the illusion that PF is contained. In reality, PF stress has not disappeared. It has been time-shifted. Once refinancing windows close simultaneously due to FX, funding cost, or regulatory tightening, loss realization becomes discontinuous, not gradual. That is why FX reacts first. Annex 6. FX as the clearing mechanism of last resort. The most critical blind spot is the belief that FX volatility is a separate phenomenon. In this regime, FX is not a side effect. It is the only remaining market where price discovery is still allowed to occur in real time. As domestic asset prices are defended through credit extension, regulatory friction, and narrative stabilization, FX becomes the outlet for balance sheet stress, capital reallocation risk, and policy credibility constraints. The weekend emergency meeting confirms this transition. The system is no longer asking how to calm the market. It is asking which stress can still be allowed to clear without breaking something else. Annex verdict: why these bombs matter. None of these submerged charges will appear suddenly in headline price indices. They will surface as execution failure, policy exhaustion, liquidity discontinuities, and forced decisions under time pressure. By the time the narrative changes, the adjustment will already have occurred elsewhere. This annex exists because those layers are not being discussed publicly, not because they are speculative, but because they are structurally inconvenient. ODP stress variable definition, FX vibration UKRW. What vibration means in the ODP framework. Within the orthogonal differentiation protocol, vibration V is not a price level nor a single shock event. It is formally defined as the temporal behavior of perturbation across three dimensions: frequency of recurrence, amplitude of oscillation, systemic capacity to absorb or amplify repeated disturbances. Applied to USD KRW, V to a high exchange rate, V equals velocity plus recurrence plus persistence of FX movements over time. Concrete mapping, KRW stable near 1,350, low V. KRW spikes once to 1,480 and reverts, medium. KRW oscillates repeatedly, one's a 420, 480, thou 450, thou 490 over weeks. Under ODP, the price is secondary. What matters is temporal resonance. A system can absorb a shock. It cannot absorb repeated oscillation without structural fatigue. This distinction is foundational and non-negotiable. If your organization requires structural clarity, BBIU is available for private briefings and strategic analysis. To initiate contact, visit biopharmabusinessintelligenceunit.com and reach out through the institutional access channel.